heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York and San Francisco, this is Bloomberg Technology. Coming up, the EU plans a 9% tariff on Chinese-made Teslas. But that's less than first threatened. We discuss the EV trade tensions.
And cyber strength, Palo Alto Networks jumps on solid earnings. We sit down with the CEO.
And we head to Chicago to delve into the DNC, which tech donors and influencers are making their mark. All that and so much more coming up. But first, let's check in on these markets because we're actually coming off of what have been very close to record highs. We've been higher in earlier trading, but now we dive a little bit, just 0.25% on the S&P 500. Ed, you've been pointing out that if we manage to end in the green, that would be 9 straight days of gains for the S&P, the longest winning streak that we've seen in 2 decades, since 2004. The NASDAQ just sinking the most of the benchmarks. NVIDIA, some of the chip makers on the downside at the moment. Maybe we're just taking some profit as we get worried about some of that labor data coming out tomorrow. Will there be revisions? I'm looking at Bitcoin, though, managing to shrug off some of the risk asset concerns. And we're up 0.25%. We had been up more than 2%, though, Ed. Let's just delve into what you're watching, though, on the micro.
Well, Tesla's an interesting mover. Tesla, actually, it's worth noting, in line with the broader market, went from a pretty marked gain, almost 2.5% earlier in the session, currently down 0.7%. The story is a 9% additional tariff of China-made EVs that are sold within the European Union. It's worth noting in the context, of course, that there are other automakers, domestic Chinese automakers, with much heavier levels of tariff relative to Tesla. So it's a positive number. But the market generally did take a weird move in the last hour or so, which kind of accounts for that. But I think we should discuss it more.
Yeah. Let's do that with Craig Judell for more on the Tesla angle and more broadly. Look, what already are we seeing? We're seeing a 10% tariff, then 9% extra leveled at Tesla because of some of the subsidies, the cheaper batteries, for example, that they're able to allocate in China.
Yeah, so what we've had here is this is, as tends to be the case with the EU, a months-long process of many approvals upon approvals to advance a decision being made. In this case, Tesla had the ability to go to Brussels and say, look, we think that we should be subject to a lower tariff rate because we aren't as subsidized as, say, a BYD or SAIC. And they were able to make a case to the European Commission that indeed they haven't had as much support as some Chinese companies, some of which are state-owned, I should add, too. SAIC, it not only is subject to a much higher tariff rate because of the level of subsidization, but also because the EU made a determination that they weren't helpful enough in the investigation, and lack of cooperation led to more punitive tariffs for them. So in the end, 9% is a much smaller incremental tariff for them, but it is not necessarily something you want if you're Tesla and you're relying on China as a major source of your Model 3s, and most people just sort of believe that the Model 3 is entirely sourced from China for the EU. And so, a 19% tariff kicking in later this year isn't necessarily something to be excited about, even if it's not as bad as it could have been.
The lead of the story focuses on Tesla, but there are other names involved here, Craig, that sell models into the European Union. Who are they? And just on your point you just made, I mean, there is the matter of Tesla's large operation in Berlin, where they also make vehicles.
Yeah, I think SAIC, BYD, and Geely are the 3 companies that were sampled, which means they really were the ones that the EU came and took a much closer look at in terms of trying to come to some determination of how much they've been subsidized over the years, and so those 3 are called out specifically, and then separately, companies that do ship from China into the EU are subject to rates based on whether or not they cooperated. So, this is not a case of, just Tesla being subject to this. It is very much an industry-wide story, and it's something that's of concern even for, manufacturers like Volkswagen and BMW that, are not only concerned because they had plans to, ship a small amount of vehicles from China into the EU, but also because they're worried about blowback, right? They have much bigger presence in China that, has come under pressure by the fact that these, Chinese manufacturers had become so competitive that they're really worried too about this, resulting in, higher tensions, potentially more nationalism and more opposition to their, really having a future in such a big and important market for them.
Okay, Bloomberg's Global Cars editor, Craig Trudell, thank you. I want to go deeper on this story, get the broader dynamics around EV tariffs. We're joined by Julia Poliskanova, Senior Director of Vehicles and E-Mobility Supply Chains at Transport and Environment, a European advocate for clean transport and energy. And I think that's a great place to start. The Commission's motivation and rationale for placing that kind of level of tariff on China-built cars. What is the point? What is the purpose here, Julia?
I think the main purpose here is to actually make the case for local manufacturing in Europe. This is not about the nationality of manufacturers. It's about where electric vehicles and batteries are produced. We have to remember that the entire premise of the energy transition and green transition in Europe is happening on the promise of new jobs, growth, and new opportunities. And it won't happen if everything is imported, not such critical technologies like EVs and batteries. So this short term, these tariffs is really the right answer to make the case. What I do think is really important to stress and remember that tariffs alone will not save the market share of European car makers. The only strategy that can help them is to front-load affordable electric vehicle models. And that's what we're missing right now from many Western brands.
It takes two to tango, as we say on this program. It's also in response to kind of Chinese government level subsidy, the different market and competitive dynamics. How conscious is the EC in that when they come to a decision, as they've done with this group of EV makers?
No, that's of course quite important, and that has been the original aim of this entire investigation. I think it's quite important to stress that in Europe, compared to the US, actually, in the EU, we have specific duty rates for different car makers to account for the different subsidization rates. For example, you would have much higher subsidization in more state-owned companies like SAIC with their brand MG in Europe. That's why they have the highest rate, compared to someone like Tesla that, of course, as a foreign car maker, will not receive the same subsidization, even though they will benefit more broadly from cheaper supply chains in China. So that's a big consideration. The level playing field is important, but as important is a push to also localize some of these industries in Europe.
As you mentioned, SAIC's got 36.3% additional duties that it's currently facing, so some of the highest among there. Tell us a little bit about the nuance that the EU factors in for relationships that local car companies have in China with China to produce.
So right now, we actually don't know much detail about that. The only thing that we know is that there is a possibility for a lower rate duty for some of those joint ventures when they will start importing some of these vehicles, electric vehicles, into Europe. So we're likely to find out more about them as these joint ventures basically start operating.
Julia Poliskanova of Transport Environment. Good to have you here on Bloomberg Technology and talk all things EV from the EU. Thank you very much. I want to get to a headline that's just crossing the Bloomberg. Tiger Cub David Goel is shuttering his $11 billion firm and returning client cash. According to sources, Goel told clients in a letter that he made the decision to close his hedge fund due to health problems. Matrix Capital Management makes concentrated tech-focused stock bets in its hedge fund where the majority of the assets lie, but also has a private equity fund. That story now on the Bloomberg and on Bloomberg.com. Check it out, a big breaking story in the world of tech. Now, coming up on the show, we're live from Chicago for the DNC. Stay with us. This is Bloomberg Technology.
ever, about 200 social media content creators have received privileges, such as access to delegates and studio space over the Democratic Convention. Bloomberg is live from the DNC in Chicago, and Bloomberg Business Week's Brad Stone has the latest on what tech names and themes are in focus. Brad, it's all about Brat Summer, the social focus. It's been going really well for Harris, and looks like she wants to continue that.
Hi, Caroline. Yeah, absolutely. Welcome. Hi from Chicago, where the name of the game here at the DNC is a little bit of relief and a lot of unity. Social media is obviously part of the party's strategy. Yeah, you mentioned 200 influencers. They are getting what the party is calling the blue carpet rolled out to them. You see a speaker, an influencer speaker every night here at the convention, obviously trying to challenge former President Trump's strength on social media and TikTok in particular, and the party's making a bet that perhaps these influencers can reach a younger generation.
All right, Bloomberg's Brad Stone live from Chicago. Thank you very much. Now, it's no surprise that the DNC features names like California Governor Gavin Newsom or U.S. Secretary of Transportation Pete Buttigieg. But what may be unexpected is where these Democratic players are showing up. The Fox News studio. Bloomberg's Hannah Miller joins us and has been writing about this in Bloomberg Business Week. And all you need to do is turn on your television, pick up your cell phone and see the video clips and where they're taking place. What's your reporting told you, Hannah?
Yeah, so all the Democrats are going on Fox News. Some of the biggest names for the party are showing up in their studio. They're trying to tap into, independent voters, people who are undecided. Fox is the most watched cable news network, and they know that this election might be decided by, a few swing states, and they want to reach those people.
Okay, the people that they reach, how do they reach them? What sort of shows are they appearing on? Because it's not the very late night programming, it feels like.
Yeah, so the Congress people I talked to, they had a preference for daytime news. They were like, we want to stay away from the evening entertainment stuff. One congressman actually said he didn't want to be used in propaganda. So, they're picking and choosing where they go, but many of them I spoke to, they've had very positive experiences going on Fox.
Hannah Miller, all over the focus of Fox at the moment. We thank you so much. Meanwhile, let's just talk about Donald Trump. And a month away from being able to turn his paper social media fortune into cold, hard cash, it would seem. The question is he going to do it? We're talking DJT here. Bloomberg's Bailey Lipschutz can talk about why. This is his media company that's backed. And he could finally come into the tune of what? More than $2 billion?
Right now it's $2.5 billion. It really depends where shares are trading. But if the other things being equal, right now, a month from now, Donald Trump could start to sell down that $2.5 billion stake, which would be magnitudes higher in terms of value that he's really had in any other venture.
Mm-hmm.
Bailey, I kind of want to go back to basics. We're essentially talking about like a lockup expiry, but this was a SPAC, and we're talking about a former president who's running for president and is an insider who can sell shares. It's just a wonderful story. Just give me basics and more detail, please.
Yeah, basically, this company went public back in March. In the terms of that lockup, essentially 6 months from that debut on March 26th, he would be able to sell shares alongside those co-founders, former The Apprentice participants that kind of helped come up with the idea, as well as Patrick Orlando, who was the financier behind the SPAC that took it public. So the terms and conditions related to that, you essentially have to wait just about 6 months to be able to start selling that down. Obviously, the big question is, will he start selling? How quickly would that look like? How would that pressure shares? When I talk to investors and people who pay attention to these so-called de-SPACs companies that went public via blank check, the expectation is that the co-founders and the SPAC founders likely would have every incentive to sell shares as quickly as possible, just given the fact that the company has only generated $1.6 million in revenue for the last 6 months, despite a more than $4 billion valuation. But it's going to be a tougher needle to thread for Donald Trump, again, given the fact that that it is potentially his crown jewel. The stock does trade under his initials, DJT, and trying to not feel like he left some of those followers hanging were he to quickly exit shares, and that would obviously pressure shares tremendously from the greater than $22 level they're trading at right now.
I mean, they've been pressured because he's returned to another social media site as well.
Yeah, the stock is down about 20% in the last 8 days. He has returned to X. He did that question in kind of conversation, I guess he called it a chat with Elon Musk on X last week. So kind of the staying power of Truth Social being his megaphone of choice, that whole idea is kind of being thrown. That some investors maybe were leaning on, but the broader question of what can this company turn into obviously has been kind of in doubt, at least if you talk to traditional institutional investors, since it really announced this deal back in October 2021.
Bailey Lipschultz all over the meme stocks this time. DJT, we appreciate it.
After a turbulent end to July for markets, global asset prices have largely rebounded, but not Bitcoin. Still, institutional investors within the digital asset space remain bullish on Bitcoin, citing increasing functionality. Elise Killeen is the founder and managing partner of Stillmark, a leading Bitcoin industry VC firm, and joins us now. One of the things we discussed on the show is in the month of August so far, some of the anxiety has been government seizure or holding of crypto assets in various contexts and what they may or may not do with them. That might be something contributing towards downward pressure. What have you made of some of the volatility in the short term of August so far? Good morning.
Good morning. Bitcoin's August price drop is typical of the market consolidation that has historically happened with Bitcoin at this part of its 4-year market cycle. And so we're seeing for the past several months sideways trading that really reflects a very standard action for Bitcoin in this part of its market cycle. And so we're not seeing anything new. We also know that Bitcoin has been risky as a short-term investment, but very consistent and reliable as a long-term investment. And so long-term investors are still orientated towards what is most important for Bitcoin's price and Bitcoin's robustness, which is adoption and, of course, expansion of its utility set.
Elise, really quick, when you say consolidation, whether it's typical or not, what do you mean by that? The basics of that, please.
Sure. So so the cycle is set, Bitcoin's 4-year cycle is set by the halving event that decreases by half the reward that Bitcoin's miners get when they discover a block. Typically at this part of the cycle, we see sideways trading, and that has historically been predecessor to an increase in price in subsequent quarters. And another thing that we should point out here is that what has been new and exciting about this cycle versus historical cycles is that Bitcoin reached an all-time high much earlier in this cycle than it has in prior, which may be indicative of a need for a cooling off period before continued price appreciation. But as I said a moment ago, of course, what's important is the long term for Bitcoin, and that's about adoption and Bitcoin's utility.
You have been in the space for a long time, one of the first institutional players in it, making your first investments from an equity perspective in 2014. So where then is the catalyst? What is ultimately those who've been drawn to the asset class going to be the next wave of excitement about adoption and use cases?
So those that are looking at the opportunity for Bitcoin ahead are really thinking about 3 things right now. That's the maturation of Bitcoin's financial ecosystem, Bitcoin for payments and the acceleration of adoption there, and then historic activities that were popular or popularized in the crypto sphere moving to Bitcoin as they mature. So in terms of Bitcoin's financial ecosystem, the ETF has done a lot to add a stamp of approval to Bitcoin as an asset. And what we are seeing within the diversity of issuers is competition start to emerge between issuers in terms of the technical presentation of the product. And that's very healthy to see. So as an example of that, or the most important example of that, is the introduction of proof of reserves through Bitwise's integration with Hoseki, which is a Stillmark portfolio company, and that allows Bitwise to offer transparency to holders of its product that Bitwise actually has the assets on hand that it requires for its users, for the promises that Bitwise has made to its users. We're pleased to see the market mature in that way. Now, what we're also expecting to see and have begun to see the early movements of is ETF, those new to Bitcoin through the ETF begin to mature their portfolio. If your exposure to Bitcoin is through an ETF, of course, you're missing some of Bitcoin's properties and some of the value that Bitcoin can offer you, including the ability to transact or to avoid systemic risk.
And sorry to cut you off there, but ultimately, the movement that you just talk of, who is making that move? Is it the institutional players, or is it actually more the retail community who buy inside?
That's a great question. And it's both. And what they're doing is maturing their portfolio. So retail players now have an option not just to hold an ETF, but to mature their portfolio by, for instance, adding products like BTC-denominated life insurance. They also have the option to hold Bitcoin themselves, and those self-custody software solutions are maturing. So what we saw very recently, just earlier this summer, was the introduction of what's known as multi-sig security that has historically relied on specialized hardware devices, move away from that reliance. And really what that means is that multi-sig security now can be accessed by people that want to use their phone or a YubiKey or something simple.
We appreciate it. Talking us all through the use cases, Stillmark founder and managing partner Elise Killeen. Stay well. Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. I want to show you a chart, Cara, that I shared on social media, and I wonder if I jinxed what's happening in the markets, given that in the last hour, major indices went the other direction. But what's so interesting is the NASDAQ 100 had been on track for a 9th straight day of gains. And what's interesting is that the 8 days through Monday night session were the biggest jump over an 8-day period going back to 2022. Even though we're talking about treading water to Jackson Hole on Friday, or like Nvidia's earnings August 28th, there's a bit of momentum right now in technology shares, and I find the NASDAQ 100 to be a great index to track given the mega cap presence, but also the higher multiple software names. There's one specific name I'm looking at as well, Palo Alto Networks. Intraday, on track for its best jump since February. If it closes at this 8% gain, on track for its biggest jump since August of last year, a strong outlook, particularly on the bottom line, boosting the share buyback. But this is a company that warned us in February earlier this year that some of the cyber spending for one of America's leading cyber names was sluggish, and that doesn't seem to be the case at this time. Let's get into it.
Yeah, with the perfect person too. Nikesh Arora is with us, Chairman, CEO of Palo Alto Networks. And Nikesh, congratulations on the numbers. And what's notable is some of the analysts, for example, Jefferies, pointing out that most importantly, you are continuing to take share via consolidation. Who do you take that share from? How do you take it?
Well, thank you very much for having me in the show, Caroline and Ed. Look, cybersecurity is a very fragmented industry. Even despite being the largest player, we're only about 3 to 4% of the market. So the entire industry is full of many, many, many small players. And part of the opportunity, which we have alighted upon and have been working really hard over the last 6 years, is to try and consolidate our customers' portfolio to a simple platform that allows them to consolidate a lot of the vendors they have, and thereby getting them better security and a lower cost to operate. And that's kind of what ends up happening for us, where we take share from a lot of small players who, to be honest, it's time for the market to start consolidating anyway.
Herein speaks platformization, as you call it, and basically seeing a sequential increase there. But how much, dare I say, were you taking some market from a rather bigger player as people lost faith in a CrowdStrike, for example, post-outage?
Well, look, a lot of our platformization, I'm trying to get in with Riz this year, so let's see if you can get there. But the part of what we're trying to do with platformization is that we're actually trying to give the customers the ability to consolidate a set of activities they do across their cybersecurity landscape. Now, we're seeing share from businesses which have been around for 15 or 17 years, effectively sold legacy technology, which the customers are replacing with us. We're seeing share consolidating from smaller players. We're seeing some share from competition. But I mean, the outage is a different matter, and we can talk about that. But that's not the primary reason for us getting share in the market. It's just lower cost of operation and basically great security outcomes.
Nikesh, you know me. I just want to get the basics.
Yes.
Some specific new customers were won as a result of what happened with CrowdStrike in the quarter. You specifically signed some deals because of what happened?
Look, the CrowdStrike outage, which was very widespread, caused many of our customers to ask, why can it not happen to Palo Alto? And we were very quick to respond because we run it fundamentally differently than the way some of our competitors do. And that gave our customers comfort. So while we were in mid-flight, they were reassured by the fact that we do it differently and it's unlikely to happen to us. So obviously we got business from those customers who were in the midst of an RFP trying to decide whether they should go with us or somebody else. So I think that was helpful. I think customers are more willing to give us consideration now because they feel like, we have a very good product in the market and they don't have to go only with one vendor in that particular category. So it's good.
Nikesh, RPOs, remaining performance obligations, it's something that we actually discussed in a number of theaters. ServiceNow, for example, you've stated that you prefer that as a measure, and you guys know, because you do the time with them, some of the sell side are not as optimistic that it's a good measure of performance. Why are you sticking with it?
Look, Ed, the sell side adapts to finally what companies tell them and how companies measure their business. What is important for us to go out and execute on our platformization strategy and make sure we give the market the right metrics to understand our business. And really, there are two things that you should worry about companies. One, what are they doing in the short term to make sure we're able to pay our bills, make sure we're able to deliver on a regular and consistent basis. In a short term, we think the best measure of our business is revenue and spend. Are we getting enough revenue? Are we spending just enough to be able to deliver immense amounts of profitability and free cash flow? And the long term, you're trying to make sure that we have a large contracted book of business so we're not chasing things on the last minute. And the RPO is a very good indicator of the long-term contracted business that you have to deliver, and it's going to show up as revenue. So as long as you keep growing that long-term business rapidly, your customers, your shareholders should know that there's a lot of business we're going to deliver and service, so our revenues are going to be robust and allowing us to deliver great profitability and free cash flows. As simple as that.
Within that simplicity of profitability and revenue, how much can you break out what AI and the adoption there is really driving your business for us?
Yeah, we're very excited about our AI capabilities and portfolios. Look, we took it early. We went ahead and went to the drawing board and say, what's going to happen when customers want to use AI? I'll tell you right now, it's fair to say almost 20% of almost every company's employees are experimenting with some sort of AI application. And the companies have no idea what these people are using. They have no idea how to control their usage of AI. They have no idea what kind of data is being uploaded to all these AI applications, which are going to use that data to train themselves to get better. So we have gone out and launched a series of products that allow you to monitor how AI is being used to make sure your data does not get out there and train models if you don't want it to, give you some visibility as to what's happening. At the same time, if you're trying to deploy an AI application, we have capability to give you a ring-fence security around your AI applications to give you an AI firewall. So that, coupled with the fact that we've infused AI into many of our products, has allowed us to deliver $200 million of ARR so far in the category of AI security, which we think is an industry first and really gives us comfort that this thing's going to do well for us.
Just give us the bird's eye perspective, though, because the whole market is grappling with the idea of whether the amount of money going into AI in terms of infrastructure is a long-term return that they're going to be getting from. Do you think there's hype within AI adoption, or do you see that actually the level of adoption from yours is showing that this is real?
Well, Caroline, I was an internet analyst in the late 90s, and I remember the hype that we saw with the internet, and everything went up and to the right very quickly. Look forward, 25 years later, everything was real. I think so. The question is not whether it's real. The question is what's the timing of it, and how do you invest in a manner that is consistent with the timing of return. So from our perspective, yes, we expect that there will be widespread usage of AI. We think AI will fundamentally change how we all conduct business. The question is, what is the timing of it? And the problem is you can't go ahead and execute on it if you don't build the infrastructure. So I think, yes, we have to have infrastructure. Now, whether it's the right amount of infrastructure being built at this point in time or not, I'm no one to comment. But I do believe that there's going to be phenomenal amount of consumption, deployment of AI, and we're going to be talking AI for a very long time.
Nikesh Arora, CEO of Palo Alto Networks. It's great to have you back. here on Bloomberg Technology. Thank you very much. Now, US cyber firms are warning that proposed regulations in Hong Kong could grant that government unusual access to the firm's computer systems. The warning comes from a number of tech groups that do business in Hong Kong, including Amazon, Google, and Meta. Hong Kong officials say the proposed rules are designed to protect critical infrastructure from cyber attacks. Karen.
Coming up, Ed, brace yourself. We're going macro. The rate cuts that we're anticipating to come, what does it mean for VCs? Well, Bradley Tusk is joining us on how VCs are preparing for the world around them to change. First, though, where else is changing? Europe, when it comes to who is building chip manufacturing equipment and indeed breaking ground. A German plant by TSMC starting today, 10 billion euro German plant. This is all about the chip war and wanting to bring supply chains closer to home amid that US-China tension. We're off by 2% though on TSMC's depository receipts. This is Bloomberg Technology. Let's just look ahead to Jackson Hole, which is this week, and get a read on venture capital's view of a potential rate cut from the Fed, and if it would help the industry. Tusk Adventures CEO and co-founder Bradley Tusk joins us now for today's VC Spotlight. And so, is the macro picture all-encompassing right now? Are you factoring in rate cuts and an energized VC community?
Yeah, look, we absolutely need something to change the way the market has been the last few years. There's been a terrible lack of liquidity in the VC market really since 2021, and we're waiting for something to shake it loose. So interest rates cuts are certainly part of that equation. The less attractive fixed income is, the more the venture may look good as an alternative. I think the election is the other big one, right? And it's not that President Biden has necessarily been bad for venture capital, but there really, other than in his first year, has just been no liquidity at all. So seeing a change in president, a change in regulators, a new SEC chair, a new FTC chair, I think can only help.
It's interesting that we have had big valuation cuts from the public side when it comes to some of the losses we've seen prior to what have now been a run-up in the markets. I think of who this has hurt. A lot of them, the Tiger Cubs, for example, some of the hedge funds. We just had the news that one key Tiger Cub goal is closing his $11 billion firm. That's citing some health issues. How much turnover do you expect to see in public investment, in private investment when it comes to VC and public equities?
A lot, because one, too many funds were raised during kind of the boom period of, say, 2017 to 2021. Too much money was raised. The reality is, so we're early stage investors. We do seed and Series A. Our average check size is about $5 million. I don't need a $300-400 million early stage fund. Sure, that makes me more money in management fees and it transfers the risk from me to my LPs, but that's not good for them and it doesn't help us make a lot of carry. And so the reality is you don't need funds that are so big. And the reason why companies were so wildly overvalued is VCs raised funds that were way too big and they couldn't write a check for, say, $5 million. It had to be for $15 or $20 million. And the valuations had to then be increased commensurately. So everything was way out of whack and it would get to the public markets and they would cut the valuation by 60-70%, rightfully so. A lot of private tech companies can be very valuable, but that doesn't mean that WeWork should be worth $40 billion, right? It was probably never more than a $1 or $2 billion company. And so there's probably a return to rationality to the market. But with that said, when there's no liquidity at all, what you see is a significant decline in early stage investment. And then that reduces new company formation, new technology development, growth. So you want more rational valuations, but you also want a lot more activity.
Bradley, I'd love to help our Bloomberg Technology audience kind of understand a bit what it's like to be a venture capitalist in the context of a liquidity crunch like you talked about. So if you're a VC and you have all these opportunities on your desk, term sheets that you want to sign, why is this environment and a pending rate cut a challenge? What changes mechanically?
Yeah, well, look, when there's no liquidity, you have a few problems. One, you can't recycle proceeds. So what happens typically for us is we'll have liquidity within a fund, and then we'll use that money because the fund period hasn't completed yet to reinvest back into again. So that creates more economic activity all around. Two, when there's more liquidity, your LPs are seeing returns and they're re-upping for new funds. So there's more activity happening there as well. Everything is moving at a much more conservative, slower pace when there's no money going out the door to anybody on any side. So it just slows everything down considerably. And then the other problem is the temptation around AI, right? So the one place where valuations have remained really, really high is in the AI sector. And yes, is there a lot of long-term potential in the space? Of course. But, we keep seeing companies with $1 or $2 million in revenue asking for $100 million valuations, and that's just crazy.
Bradley,
yes.
I don't mean to cut you off. We're short of time. The presidential election, which candidate is the candidate of the entrepreneur and of the venture capitalist?
I mean, ultimately, I am supporting Harris. I have given Harris a considerable amount of money because I believe that having stable markets and a government that is somewhat trustworthy and functional is ultimately a lot better than the chaos of Trump.
Tusk Ventures CEO and co-founder Bradley Tusk, I appreciate you answering that. Thank you very much.
Appreciate it.
Edgar Bronfman Jr. has formally submitted a $4.3 billion bid to take control of Paramount Global and quash an existing offer from Skydance Media. That's according to a Bloomberg source. Bronfman is expected to argue that his proposal is superior because it will result in less dilution for Paramount's non-Redstone shareholders. We'll keep tracking it. Caro.
We should. Meanwhile, of course, Fubo TV soaring after Fox, Warner Brothers, Discovery and Disney were blocked by a judge from launching their streaming sports service just 1 week out before its rollout. Fubo TV CEO David Gandler joined Bloomberg yesterday to react to the news. Just take a listen.
Is that the consumer is the big winner today. The joint venture attempted to deprive consumers of choice and affordability. It attempted to eliminate competition and manipulate pricing. And I think the evidence was quite clear, given that the bar is so high, and we're just happy the judge has agreed with us.
So it's likely that Venue will make its case again before the court. What are you going to be doing before then? Because it's not clear how long this injunction will last.
Well, we don't have a date yet set for the trial, which could be in 2025 or 2026. Fubo today is focused on the fall sports calendar. We're not focused on any potential appeal. Pun intended, ball is in their court. So we'll continue to focus on our business and continue to, achieve profitability as we have forecasted in 2025.
I am curious, David, too, about the structure of that Vino deal. There was some discussion, I guess, based on the reporting coming out of the hearings that led up to the ruling, this idea that they were asking, I don't know if it was specifically you, but they were asking some of the rivals that they would, in addition, if they wanted the sports programming, they also had to take additional programming as well. Is that true?
Yeah, that's correct. I think one of the arguments that we were attempting to make is that not only were there excessive above market rates that we were dealing with, excessive penetration rates, which is the number of subscribers that gain access or have access to each of the networks, which obviously comes at a higher cost, but it's also the bundling of unwanted channels to access must-have sports programming. Those are the sort of key elements of the trial. And again, we believe that we're able to provide the judge with sufficient and credible evidence for her to judge in our favor.
That was Fubo TV CEO David Gander. Let's discuss what this means for the future of sports streaming with Paul Pastor, co-founder and chief business officer of the cloud-native platform QuickPlay, but also a former Disney Plus and Hulu executive. You're an alum of Disney Plus and Hulu. You have some direct history with Venue. Your reaction to the comments there?
Sure. Thank you again for having me. Listen, I agree and disagree with David's statement on terms of what's happening for the consumer. I agree that the court essentially laid out an argument that said it was unfair to have the practice that they could not avail themselves, that being Fubo, of the market rates that the Venue venture was having. And importantly, they couldn't unbundle the networks that were part of that venture. However, for consumers, they also lose. this ability to aggregate the offering, to be able to offer new discovery tools, these are things that consumers want and are seeking out. And so this is both a win for the consumer and the fact that that David's pushing for more availability and more pricing flexibility within the bundle, but also a loss in terms of the innovation that could be applied against the sports bundle in general.
Paul, regular viewers of this program know that I'm a passionate, long-standing Chelsea season ticket holder. So for football, I've got Peacock. I've got CBS if we were ever to get back into Europe. I've got Sling so I can get Fox Sports. Why do I need Venue?
You and I are alike. I also am a huge fan of the Tennis Channel, and I have to buy through a cable package in order to get to my Tennis Channel. Listen, I agree. I think actually one of the hardest value propositions here is to communicate to a consumer that this bundle and Venue actually doesn't deliver all the sports that they're looking for. It's only an efficient way to consume the things that are in those channels. Now, this was a very strong value proposition when we did this with Hulu, with ABC, Fox, and NBCU at the time. So there is value that can be created. There is an ability to speak to the broader offering and how it competes, but most certainly it doesn't solve all the problems of how you actually manage your sports rights.
Yeah, add in there NBA rights moving to Amazon. Paul, paint a picture of what then the next spring season, what ultimately sports looks like, how we're going to best interact with it, do you think, via streaming?
Sure. So listen, I think that right now what we saw, right, the NBA just came to market. And what we saw clearly was that Amazon came in and understood that there was a place for them to play in this, and ultimately streaming rights will now go to Amazon in addition to being shared across a number of other services. Right. What this ultimately means is there's strong value in sports. It's a live event. It delivers huge impact to both advertising and to potentially ancillary businesses that are being managed. The challenge is that for consumers, it's still going to remain a very difficult landscape to navigate. And while the Venue package certainly looked to bring together some of those rights and offer at least a more efficient way to be able to consume a certain amount of those sports rights, it doesn't solve the ultimate problem of having to navigate across multiple services, seek out where they might be.
The struggle's real for sports lovers. Paul Pastor, we thank you so much, co-founder and chief business officer at Quick Play. Some great expertise there. Meanwhile, that does it for this edition of Bloomberg Technology, Ed.
Fantastic show. Don't forget to check out the podcast for the recap. You know where to find it. Bloomberg and online and Apple, Spotify and iHeart. From the team over in New York City and here in San Francisco on the West Coast, this is Bloomberg Technology.